From WBRN Radio in Boston and on the Bostonred Network. On some of these channels we come from New York, but nonetheless this is Numbers Man. This week in economics, our macroeconomics program, that we look at industrial nations, their output, and how it affects the international economic climate, the central banks, and we also look at the markets because the markets themselves in many of the countries have a paramount influence, at least in the business community. Now you have to separate out in some countries the business community from the political community, or as some would say, the political elites. In the U.S., the political community, as we were witness to on Friday, the Republicans had a gigantic plan to change the Affordable Care Act, commonly known as Obamacare, the United States attempt at some type of national insurance program or standard. It failed. The Trump administration had promised they would abolish the Affordable Care Act. The Republicans have been trying for 7 years to do it. And now that they had the opportunity, various political factions within their party defeated it. You just simply cannot throw millions of people out of health care and get away with it in a political sense. Now, on the economic side, the various medical associations, the AMA, the Medical Centers Association, all across the board opposed this, what was called the American Health Care Act, because it would affect their bottom line in a very negative manner. You could expect the changes to Medicare would in itself, and Medicaid, by returning it to the states in a block grant form, fewer and fewer people would be covered. Therefore, you'd have fewer patients in medical centers around the country. You'd have massive layoffs. There was also chaos within the channel. The various hospitals did not have any type of hiring standard. One of the things that happens in any business, whether it be profit or non-profit, you have to have some projection of costs in years to come. You can't simply say, well, this is what it will cost in July of 2017. You need to at least know 18, 19, 20. The standard is usually a 5 years projection, some less, maybe 3 years. But 5 to 10 years, you look at this, and of course, when the Congressional Budget Office scores something, they were looking at, this was a 10-year outcome, 24 million people later. This was totally unacceptable to many of the Republicans, and then on the other side, you had people that were more financial types, dealing with the rise in the deficit. One of the things that happens in a modern industrial economy, you are going to run up deficits. So this debacle has ended. A quote-unquote black eye has appeared on the Republican leadership in the House of Representatives and on the President DJ Trump. His writing of a book called The Art of the Deal that applied to business deals in the 80s was not applicable up to the standard in 2017. A totally different type of book, a business book, a rah-rah book. It would go under the category of Dr. Greenspan's irrational exuberance. You cannot run a nation on irrational exuberance. Yes, you can, for a period of time, give motivational speeches, etc., and the markets will follow you. Particularly the commodity markets will go up, but they can't sustain it, and this is part of the problem that we see. And we continuously hear about how many jobs are created. The administration has given the green light to the Keystone pipeline. There are all kinds of estimates as to how many jobs it will immediately create. Roughly about 3,500, maybe. We don't know until they're actually created. This is one important point. And how many jobs will remain after the actual construction. one report in the Department of State, about 35, we can say 50, but not very many jobs. These short-term effects on local economies. If we want to look at the effects there, and I hope to get a study in out of, say, North Dakota. You won't go to Texas because the economy there has a yo-yo effect. It's up, it's down. If the energy companies are down, the economy is down. But in North Dakota, they had the fracking epidemic there. People moved in. The cost of living went up dramatically. The price of homes, lodgings, lets, etc., apartment prices doubled, we'll say, from about $500 to sometimes as many as $3,000 a month. People were living in caravans or mobile units, cars, anything they could live in to utilize these jobs, and some were paying as much as $75,000 or $100,000 a year. They were exaggerated, but the jobs did not last. And when the jobs themselves disappeared more or less from the economy, the state was left with the infrastructure that they had built. Fortunately for them, it didn't last long enough to build the additional infrastructure, schools, etc. So now they have at least a 5 or 10 year situation there where they can look at that and the standard of living has improved. But at the same time, the so-called growth there was not a natural growth. Thus, they are left with a much smaller tax base than they had at one time. So these pipeline improvements are there. As a lady was explaining to me out in Nebraska, that is where the Keystone pipeline at present time ends, and it will start and it will eventually end up down at the Texas Gulf Coast. But now there is a section of it that goes from the state of Oklahoma on to Texas. So, in other words, this particular pipeline would be extending from Nebraska on down to the Oklahoma terminal. And there would be jobs there while they're building it. But again, this is part of the problem with the whole jobs program. And we look at other jobs. We were just looking here, the Reuters Dispatch carrier, the internet broadband provider, moving some call centers, moving some other things around, would create, and they had announced this 2 years ago, with the Time Warner Cable merger, roughly 20,000 jobs. Well, the problem you have on this, that's an estimate, but technology does, in fact, go into it, and advancements in technology, particularly algorithms, etc., automatic customer service systems, etc., would have a dramatic impact on what is going on. Much of the information now can be done via the web. You can even talk to customer sales representatives. And there was also a center being added in McAllen, Texas, which is on the Texas border. That would be a situation where you would have bilingual people speaking there. And also the area that salaries, compensation, wages are depressed in that area. About 600 jobs would be created there. But this is more of a long-term situation, and where the quote-unquote cable/broadband business will be. And you have to look at trends in broadband. I was just looking at a study here. The Internet of Things and various other things are merging. We'll merge it into a program because we just have to change things a bit around here. But this is a sort of a snapshot of where the administration's jobs program is going. And various economists, pundits, talking heads have talked about it, but it's impossible to get a prediction now because the numbers are purely speculative. And in an administration that has a lot of speculative things coming out of it, in other words, we now have in our dictionaries, we'll call it, the term fake news. Now, fake news can cause certain types of exuberance, but at the same time it can cause pessimism. People are very pessimistic about what is going on, and we look at some of these surveys. We'll go to the market people now and look at some of the PMIs and see exactly where we are. I think we have sort of an overview of, we'll start with the Republicans' tax plan, which they are going to. And the Ryan tax plan is coming out of the House. DJ Trump has a quote-unquote $1 trillion infrastructure improvement plan. President Obama had talked about the idea of infrastructure. It went nowhere. The Republicans opposed it. But under Trump's plan, it is a private infrastructure plan. And this is where it gets very, very complicated. Now, the House Republicans propose to eliminate tax breaks for corporate borrowing. But that is part of President Trump's infrastructure plan. The measure, this is from Bloomberg, incidentally, the measure would force companies to include interest they pay on loans in their taxable income, ending a 100-year old deduction that is vital to industries, including utilities and real estate. If that happens, representatives of those industries warn they would be saddled with lower profit margins, less likely to seek loans needed to finance public work projects. So in other words, that would effectively dampen this whole infrastructure idea that he has lobbying efforts to preserve the current tax treatment of interest are ramping up. The Edison Electric Institute, which represents utilities, is blanketing lawmakers with glossy palm-sized cards and one-page fact sheets, part of that process, and various other lobbying entities there. If Congress administration are counting on the private sector to help leverage infrastructure, but take away the ability of companies to leverage their investment through energy interest deductibility, then they create a big problem. There's no doubt about that. Added interest deductibility to the list of policy wrinkles that need to be ironed out. So in other words, this is not going to be a walk, a cake walk. The tax plan that Ryan and the Republicans rely upon is killing interest rate deductions to help pay for corporate and income tax cuts. And this is a very big problem to eliminate. Produces about its estimates. Produce about 1.2 trillion in revenue over a decade, making it the largest revenue generator. Among the GOP tax proposals. But eliminating the interest tax deduction just simply will not fly. The back to the infrastructure plan that was during the campaign. An important thing to note here: promises, or whatever you want to call it, rhetoric during the campaign, does not materialize generally into policy, and that has been a mistake of this administration, trying to turn rhetoric into policy. It just does not work. And there's no response from the White House on this. Now, private equity opposition, the president says companies should have a choice of either to continue to deduct the interest expense, now that is from the president, or immediately deduct the costs. So in other words, you'd not have depreciation expense for plants, equipment, buildings that have been spreading those costs over several years. It's usually more than advantageous for companies to spread those costs over several years. Private equity funds, which finance bailouts, saddling companies with debt, the promise of immediate expense investment doesn't offer much consolation. You are trading a short-term gain for a long-term increase in the cost of capital. That doesn't help asset-light businesses. That's from Pamela Hendrickson, the chief operating officer of Riverside. That's another private equity company. So there's many gaps in this. Raising the interest rates might make private equity, the private sector companies, even less inclined to borrow to fund infrastructure projects. Period. Eliminating the interest deduction changes the economic projects and increases the costs. That's according to Ryan McCormick, his senior vice president in charge of tax policy at the real estate roundtable. There are a lot of these groups out here, and as always has happened in the past under President Reagan, etc. When you start talking about taxes, they all arrive. Of course, now they're all there, but the point is you have hundreds and hundreds of lobbyists. Now, this is another problem. The GOP plan would tax imports while excluding exports. Well, you can send product out of the country. It would not cost you anything, but products that are imported, everything from avocados, they give the example here, the shoes would cost the consumer more. Now, if you came up with a policy where 99% of the products were made in the USA, well, you wouldn't have this a problem. You'd be trying to send USA products out of the country, but you'd get into trade wars there. This could cause all kinds of chaos here, and this we'll look at this from the political standpoint, but from macroeconomics, all of these sort of witchcraft ideas here, as the first President Bush called it, voodoo economics, trickle down, whatever is in this, just doesn't work out very well. Enough said of that. Let's go to the PMIs. Just try to give a little, as they say, overview. This is the market people flash U.S. PMI. The U.S. private sector expanded at the slowest pace for 6 months in March. The key findings: the flash U.S. Composite Output Index at 53.2. It was 54.1 in February, the 6-month low. The Flash Service Business Activity Index at 52.9. It was 53.8 in February, another 6 months low. The U.S. Flash Manufacturing PMI at 53.4. It was at 54.2 in February. It's a 5-month low. And the Manufacturers Output Index at 54.4. It was 55.6 in February, another 6-month low. Now, 50 is the start. The seasonally adjusted market Flash U.S. Composite PMI Output Index rested 53.2 in March, remains above the 50 no-change value for the 13th consecutive month. However, the latest reading was down from the 54. We just talked about that, and signaled the lowest expansion of private sector output since September of 2016. Salt business activity growth was driven by a loss of momentum in the service sector, down 52.9 from 53.8 in February. Data also revealed a slowdown in staff hiring by private sector companies. The latest rise in payroll numbers was only marginal and the weakest in 6 months. The composite index is based upon the original survey data from markets U.S. service PMI and the market manufacturing PMI. The flash service PMI 52.9 in March signaled only a moderate rate of growth across the service economy. The latest expansion of business activity was the weakest since September, suggesting a sustained loss of momentum following a 14-month peak recorded in January. Survey respondents noted that a soft increase in new business has acted as a brake on growth in March. Reflecting this, the latest rise in new work received by service providers was only modest and the weakest for 12 months. Some firms comment on a greater caution amongst clients despite a supportive economic backdrop so far in 2017. Staff hiring continues to ease for the 15-month peak recorded last December. Moreover, the rates of service sector job creation in March was one of the weakest reported over the past 3 years. The rate of price changed inflation remains only modest in March, with some service providers commenting on the need to absorb higher costs. Anecdotal information mainly points to rising food prices, transportation costs. However, overall pace of input cost inflation was relatively subdued and held close to the 5-month low in February. March data signaled that manufacturing production continued to expand at a faster pace than service production. Manufacturing companies needlessly indicate that growth momentum eased further from the peak seen at the start of 2017 at 53.4, down from 54.2 in February. The market flash U.S. Manufacturing Purchases Managers Index signaled the slowest overall upturn in business conditions since October of 2016. The latest reading was still well above, of course, the 50-50. Monitoring the overall trend for business activities, latest data signals of that manufacturing new order volume expanded at the slowest pace for 5 months. Input cost inflation, meanwhile, picked up in March, and this, of course, the Fed had moved the interest rate up 25 basis points. Efforts to pass on higher costs contributed to an upturn in factory gate price inflation to its strongest since November of 2014. The conclusion here from Dr. Williamson: the U.S. economy shifted down a gear in March, a slowing in pace of growth signaled by PMI surveys from the second straight month suggests that the economy is struggling to sustain momentum. The survey readings are consistent with amortized GNP growth of 1.7 in Q1, down from 1.9 in the final quarter of 2016. Inflows of new business has moderated in both manufacturing and service, the latter seeing the worsening, slowing backlogs of work are also starting to fall again, something which is commonly followed by firms cutting back on their hiring. And this is something we look at very closely. Business confidence ticked higher in March, however, providing some bright news on the outlook and a glimmer of hope that growth tended will pick up again in Q2. It's a bit hard to predict in Q2 because Q2 is usually a transitional quarter. Now, when we go into Q3, of course, we have holidays and that sort of thing in summer, and general pickup in construction normally, and other things that pick up. Now we moving, I should say, more past in the U.S. and in other industrial countries, past the brick and mortar stores. The Sears retail organization is teetering on bankruptcy. They're also seeing the Payless, low shoe operation, is now on the brink. A part of that is caused by the online operators. They can dispense these goods at a cheaper rate. Thus, the presence there will, of course, obviously affect real estate with Sears, who will occupy the stores. Well, that's a very big question there. Let's look at some more PMIs here. We won't look at them probably in as much as we did. We'll skip on to the UK households, more pessimistic in the UK on their financial prospects since November of 2013. We'll hit the key points here. Concern about future household financing. This is the market household finance index for the United Kingdom. Pressures on UK household budgets remain close to the strongest since late 2014. Workplace activity continues to rise at a robust pace, but with stagnation in March. Major UK households, 58%, expect the Bank of England to raise rates in the next 12 months. The index, which intends to anticipate changes in consumer behavior, the HFI, is compiled each month by the market people. And let me just adjust here. UK households signal a sustained squeeze on their financial well-being. In March, the degree of pressure on household budgets was little changed since February, one of the largest since late 2014. This is highlighted by seasonally adjusted household finance index, posting a 43.2 in March, well below the 50 no-change threshold, one of the weakest readings in 2 years. However, the squeeze on household finance was still much less marked than the survey recorded lows in August of 2011. The latest deterioration in UK household finances reflects a combination of subdued patrons. That index is at 50.1 in March, the second fastest increase in living costs since July of 2013. Resilient labor market conditions persist in March, with households reporting another robust rise in workplace activity at 55, and only a modest degree of concern about job security. The seasonally adjusted index measuring expectation for finance is in the 12 months time dropped sharply from 48.1 to 45.3 in March. This signaled the greatest degree of negative sentiment about future household finance since 2013. March data points to resilient labor market conditions, with respondents indicating another robust increase in workplace activity and a relatively subdued degree of job insecurity. Construction, IT, telecoms, manufacturing workers reported the fastest rise in workplace activity. People working in these sectors also signaled outright improvements in job security. Meanwhile, workers in utilities, energy, transportation, retail sector recorded the greatest degree of job insecurity. UK households reported another sharp rise in their living costs at 83.4 in March. The seasonally adjusted index was little changed from 3.5-year peak recorded in February of 84.7. The latest reading was well above the average of 77 and much stronger than seen in the same time in 2016 of 64.4. March's data indicated that UK households expect a strong rise in their living costs over the next 12 months at 90.9. The seasonally adjusted index expected living costs was down fractionally from 91.3 in February, but still signaled a high degree of expectation for 3 years. 1/3 of respondents anticipated a base rise in the next 6 months. Commentary here from Tim Moore. Households reported greater pressure on their financial well-being in March as rising inflation has started to erode incomes and reduce cash available to spend. On the average in Q1 of 2017, several respondents have reported sharp increase in their everyday living costs for 3.5 years. A combination of rising inflation, subdued patrons have forced households to recalibrate, interesting term there, expectations for the year to come after holidays. Study last summer, UK consumers are now more downbeat about their financial outlook than any time since 2013. Resilient labor market conditions was the main positive development, but the question is, how long will this be there? As a result, of the latest survey provides an advance warning that stretched household finances will become a great drag on consumer spending in the months ahead. That is from the UK, and we'll just hit Germany, the largest in the EU. Their PMI output index was 57. They're 56 in February. That's a 70-month high. Flash service PMI activity index at 55.6, 54.4. That is a 15-month high. The manufacturing PMI at 58.3. It was 56. So that's a 71-month high. So Germany posted the fastest rate of private sector output growth in nearly 6 years. In Q1 of 17, the survey also signaled a near record rate of employment growth and strong cost pressure nearing 6 years. The market flash German composite output index rose for the second month, 56.1 in February to 57, the highest since May of 2011. Data breakdown by sectors. Service sector providers and manufacturers goods continued to outpace third sector activity, rising at the strongest since 2014. Needlessly, service activity growth hit a 15-month high. Stronger expansion of new work fueled by the acceleration of overall growth in March. New business indicated the fastest rise since 2011. Notably, manufacturing new export orders increased the strongest pace since 2011. Reporting demand from U.S., China, the UK, Asia, and the Mideast. The overall strength of business conditions in manufacturing in particular were highlighted by the headline market flash German manufacturing PMI rising to a 71-month high of 58.3. The continual acceleration in rate of expansion of private sector new business placed greater pressure on operating capacity. Backlogs of work rose for the 10th month running, the longest sequel of growth for 6 years. Moreover, fast expansion since the fastest, I should say, since May of 2011. Manufacturing backlog continues to rise at a faster pace than incomplete business in the service sector. Pressures from demand prompt firms to step up recruitment. This is in Germany. The rate of private sector job creation was the fastest since 2011 and was the second strongest since the series began in 1998. The commentary here from the senior economist Trevor Belchin. The flash PMI results rounds off a strong first quarter Q1 in the German economy. The composite index posted 56 in Q1, the highest quarterly average since Q2 of 2011. Firms responded to capacity pressure in March with a rate of job creation in the private sector matching the survey's record 6 years ago. Inflationary pressures continue to build with input and output prices both rising at the fastest rate in 6 years. Market is currently forecasting headline inflation to reach 2.1 over 2017. Not a bad situation. As a whole, the latest official monthly data shows consumer price inflation at 2.2, a 4.5-year high. That's still fairly low inflation rate at current standards. The Eurozone, we'll just give you the highlights here, that at output at 56.7 and 56 in February, again on 71-month high. Eurozone service PMI activity at 56.5 In effect, the Eurozone is in much better shape than it has been. Eurozone manufacturing PMI output index at 52.2. It was 57.2. It was 57.3 there, a 2-month low. That's pretty high. But anyway, the manufacturing PMI at 56.2. It was 54.4 in February. Again, a 71-month high there. And we'll get to the summary, the comment here by Dr. Williamson again. The Eurozone economy throttled open future in March with business activity and hiring surges high. The March PMI rounds off the best quarter for 6 years, signaling GNP growth of 0.6% in Q1. Employment growth is meanwhile the best seen for a decade, 10 years. The acceleration in growth towards the end of the quarter, as well as improving trends in new business, increased appetite to hire and suggests that strong momentum will be sustained into Q2. We'll be looking at Q2 to see where we are. We'll go now to the BBC and round things out here. We pretty much covered most of the international news as we have moved along here. And a big headline here on laptop ban. The U.S. and U.K. ban direct flights from Mideast airports. Well, they'll be in the luggage. Eurozone growth for near 6-month high. We just reported on that, so we won't go into it again. Deutsche Bank will commit to a London office, whereas other banks are moving out as the Basics operation comes. I wanted to highlight robots. This is in the UK, but it would be paralleled in many countries. Robots to affect up to 30% of UK jobs. That is from PwC. Also predicts the nature of some occupations would change rather than disappear. Jobs in manufacturing and retail are among the most at risk in the new technologies, the report says. We'll see if we can impinge this report, but we'll highlight it here. The use of robots in the workplace is rising, with workers in some sectors already facing the potential challenges. So this is transportation and storage, 56% of jobs at high risk there. Manufacturing, 46%. Robotics has been, incidentally, in manufacturing a very long time, especially in motor cars. Wholesale and retail trade, 44%. Administrative and support services, amazingly lower at 37%. Insurance and finances at 32%. Professional, scientific, and technical at only 26%. And construction at 24%, very low. Arts and entertainment, one of the lowest at 22%. Agriculture, forest, and fishery at 19%. And human health and social work at only 7%. And education at 9%. So in other words, those are some of the quote-unquote safer categories for one to go into, and one would perhaps want to look at those particular categories and see exactly where they are. And incidentally, this PwC is at Bloomberg, at Fortune. Robots could steal 40% of U.S. jobs by 2030. A long ways away. And this is in Fortune. 40% of U.S. jobs could be given to robots. A new report of consultancy, PwC, that bots could take nearly 4 in 10 jobs. 38% of the jobs in the U.S., take 30% of the jobs in the UK, 35% of the jobs in Germany, 21% in Japan, where they have actually been for a very, very long time. In fact, I remember in the 70s we were talking about a robot had actually killed a human being. So we'll append this report, the UK jobs outlook here, and it's a nice little report, glossy, etc. Anyway, we'll get back here. Let's do the numbers here as we look at the actual markets where they are, probably on Friday unless otherwise noted. The BBC Global 30 at 6.13 was on Friday. The FTSE All Share was down 2.10. In Amsterdam, they were down 8.03. This is on Friday. They were down in Amsterdam at 1.09. The DAC on Friday, 24.59. In France, they were in the negative at 11.86. In Brussels, negative 15.67. In Madrid, 15.50 in the negative also. In Zurich on Friday, just negative 15. In Moscow, negative 11.27. In Johannesburg, negative 294.82. In Bombay on Friday, 89.24. In Karachi, negative 45.74. In Lahore, negative 45.11. In Colombo, see all shares there, 16.43 on Friday. And on Sunday in Tehran, 492.10. In Sydney on Friday, 42.10. The Nikkei was at 177.22. And the Hang Seng in Hong Kong at 30.57. In Shanghai, 20.90. On Friday, the Dow was down 59.86. The Nasdaq was at 11.005. The Merck, that's the commodities market out in the Midwest city of Chicago, was at negative 1.98. In San Pablo, they were also on Monday in the negative at 1,046.17. And on Friday in Mexico, they were down 648.42, also in the negative there. To the commodities, we usually skip over the currencies, but we'll deal with commodities, primarily with petro here. This is ICE futures. Brent crude was up 50 cents at $51.06. On the spot was up 21 cents at $50.30. West Texas Intermediate was up 49 cents at $48.19. Deep been picking, jumping for joy. He remembers $15 bail. Oil. Cocoa futures down $45. Coffee futures down $2.90. Gold on the Forex. Shot past it. It was down on Wednesday, $1.80 at $1,249.10. On Thursday, Dubai down 50 cents at $1,247.80. Silver was up 8 cents on Friday at $17.63. Your next life of futures, cocoa was down $32. Robusta coffee was down $16. And the Bloomberg Commodity Index was down 6 cents at 84.53 on Friday. This will do it for us. We covered everything from the anticipated tax legislation coming up. And one thing to remember about tax legislation is only anticipated. The devil is the former leader of the Senate, Harry Reid, used to say is in the details. Well, we really haven't even gotten to the details with taxing policy. But under the healthcare policy that was defeated, the American Health Care Act, the Trump administration could still do some administrative things to try to weaken Obamacare. It'd be interesting. But that's in the political part. How the economy reacts to it, we'll see play out. But overall, the European PMI is in very good shape. Germany, the strongest one, is in very good shape in Q1 and in going into Q2. And in the U.S., it is tentatively, look at it, is a sort of a mixed bag. There's still consumer confidence out there, but how long will the consumer confidence remain? Hiring is there, but it is sort of weakening. So we look at those factors, the underlying factors, and then we'll start to get some more numbers out. Will the Fed raise rates again? Yes, the answer to that. Have a good weekend, everyone. And for those in business, make next week a positive one. Now that at least healthcare is not as chaotic as it once was in the consumer, the eye on the prize. I was looking at an article. This was Walmart and Target. Some in the retail field that are still in the brick and mortar operations are now moving more and more to quote unquote the web to strengthen their brick and mortar, do more fulfillment, pick up at the stores. But the question I sort of asked myself, why would people necessarily want to pick it up at the store? It depends, because you have programs like Amazon Prime that you pay about $100 a year, etc., depending on how much you're buying. They will do this pickup at a minimal charge or for free. So once more, those things will change. The same thing at food outlets. The local market is not the same. They will send the veggies to you.